Hello and welcome to Forex.Academy, the #1 website for Forex and crypto education and analysis. In today's edition, we're going to be looking at correlated markets, understanding which pairs affect each other. When we talk about correlation in the financial markets, we are looking for assets across all the financial classes, such as stocks, Forex, bonds, futures, commodities, precious metals, and oil. We are looking for which trade positively or negatively against each other, either for brief or sustained periods. In Forex trading, we can see other currency pairs or other assets from these classes to assist us in our trading decision making, especially when we know that we can rely on correlation due to historical reliance. As an example, in the stock market, we often find that if a major bank announces a large loss due to underperformance, you might find that there is a knock-on effect in the banking sector, causing bank stocks to fall due to the fact that the market perceives a correlated risk in this sector. This was particularly true in the 2008 market crash. Stock market traders might consider trying to counter this by buying stocks in utilities companies and firms that manufacture consumer staples, which are usually seen as more of a safe haven stock. In this example, traders look for positive correlation by buying utilities, and consumer staples producers a negative correlation in selling banking stocks in order to balance their portfolios. There are many ways to measure correlation, and the larger the financial institution, the more complex measurements are used to define values in correlation, such as correlation Brownian motions, the binomial correlation coefficient, and copular correlations. The basic measurement is called a correlation coefficient and is calculated with a range between -1 and +1. A perfect positive correlation and the correlation coefficient of +1, where currency pairs will move in the same direction 100% of the time. A perfect negative correlation is measured at -1 and means that two currency pairs will move in the opposite direction 100% of the time. If this correlation is 0, the two currency pairs are said to have no correlation and will act independently of each other. We often find positive correlation with the precious metal sector, where silver will move either up or down in line with gold. An example of negative correlation would be between gold and the US dollar. If we think about this logically, gold is valued in US dollars, and therefore, if the price of gold is rising, it stands to reason that the value of the dollar must be falling in value. Some traders will buy gold when the value of the dollar is falling and vice versa, as we see in example A. When looking for correlation in equities, we find a positive correlation between the Dow Jones, the Nasdaq 100, and the S&P 500. And this is because these indices are priced in dollars, and when the US economy is strong, we would expect that these three indices are correlated positively to the upside, and vice versa when the economy is weak. Also, if the US has a strong economy, and therefore we experience positive correlation between the indices, then we might expect this positive correlation to spill over into our global equities. Again, the opposite would apply in the US downturn. Another area we would expect to see positive correlation would be the bond market, and especially when it comes to US and German 10-year Treasury bonds, which typically move in sync with each other. Other positive correlation is seen in the oil markets, where US, Canadian, and European oil stocks are heavily correlated, being supply-driven, and where the price is affected by the global economic outlook. So we know that correlation exists in the market, and traders use correlation to adjust their portfolios. But how can it help us in the retail Forex market? First and foremost, the fact that we know it exists already helps us now because we can use it as a tool or leading indicator in order to support our trading view of any particular currency. For example, the USD CAD. This pair is heavily influenced by the fluctuations in the oil market. We can see this in action in example B. Here we have overlaid the USD CAD pair with the US oil on the daily chart. The magenta trend line helps us to define areas where USD CAD, and especially the price of oil, is moving higher during the 10th to the 12th of June 2019, and the opposite is true between the 18th of September to the 4th of October 2019. This is because a major contributor of the Canadian economy, GDP, is the production and subsequent sale of oil into the oil market. Therefore, when we find the price of oil tumbling, we might see the value of the Canadian dollar to fall in relation to the US dollar due to negative correlation. Additionally, during the last few days we have seen a rapid appreciation of the British pound to US dollar, and whereby this rally was followed by the euro against the US dollar, which acted as positive correlation between the two pairs. This largely came about because of positive sentiments regarding the Eurozone and United Kingdom withdrawal agreement. Look at example C, where we can see negative around the beginning of August 2019 and positive correlation during mid-October 2019. Correlation can be seen in the most unexpected places, such as example D, between the Swiss franc and Japanese yen and the Euro-USD pairs, so it is worth looking out for examples by studying your charts regularly. The thing to bear in mind when it comes to correlation in the financial markets is that the markets have an ebb and flow to them and things are consistently changing, and therefore correlation between assets should be seen as a fair weather friend who comes and goes when they feel like it. If you enjoyed the video, please like and subscribe, and comment down below if there's anything you'd like us to cover in future, or if you would like to discuss the topics we have covered. Have a great day.